Today, we will talk about what a bull spread is, how it works as a trading strategy, and provide examples. A bull spread is an optimistic options strategy designed to profit from a moderate rise in the price of a security or asset. It involves the simultaneous purchase and sale of either call or put options with different strike prices but the same underlying asset and expiration date. If it uses call options, it is called a bull call spread. If it uses put options, it is called a bull put spread. The bull call spread is also known as a debit call spread since the trade generates a net debt to the account when it is opened. The option purchased costs more than the option sold. The practical difference between bull call spread and bull put spread lies in the timing of the cash flows. For the bull call spread, you pay up front and seek profit later when it expires. For the bull put spread, you collect money up front and seek to hold on to as much of it as possible when it expires. Both strategies involve collecting a premium on the sale of the options, so the initial cash investment is less than it would be by purchasing options alone. A bull call spread involves writing a call option for a higher strike price than the current market in long calls, and the trade typically requires an initial cash outlay. The maximum profit in this strategy is the difference between the strike prices of the long and short options less the net cost of the options. The maximum loss is limited to the net premium paid for the options. A bull call spread's profit increases as the underlying security's price increases up to the strike price of the short call option. Thereafter, the profit remains stagnant if the underlying security's price increases beyond the short call strike price. A bull put spread is also known as a credit put spread because the trade generates a net credit to the account when it is opened. The maximum profit using this strategy is equal to the difference between the amount received from the sold put and the amount paid for the purchased put. The maximum loss a trader can incur is equal to the difference between the strike prices minus the net credit received. Bull spreads are not suited for every market condition and work best in markets where the underlying asset is rising moderately and not making large price jumps. The bull call limits its maximum loss to the net premium paid for the options and caps profits up to the strike price of the short option. The bull put limits profits to the difference between what the trader paid for the two puts, one sold and one bought. Losses are capped at the difference between strike prices less the total credit received at the creation of the put spread. Both strategies achieve maximum profit if the underlying asset closes at or above the higher strike price and result in a maximum loss if the underlying asset closes at or below the lower strike price. Break-even, before commissions, in a bull call spread occurs at. Break-even, before commissions, in a bull put spread occurs at upper strike price, net premium received. An example of a bull call spread is when a trader purchases one 2-month SPX 4400 call and at the same time sells one 2-month SPX 4405 call. The total net debit for the spread is $275. By purchasing the bull call spread, the investor anticipates the SPX index to have risen moderately to a level above the break-even point by the expiration. The maximum profit potential is limited, and the downside risk for the bull call spread purchase is also limited to the total $275 premium paid for the spread. Here are 4 key takeaways. 1. A bull spread is an optimistic option strategy used when the investor expects a moderate rise in the price of the underlying asset. 2. Bull spreads come in 2 types, bull call spreads, which use call options, and bull put spreads, which use put options. 3. Bull spreads involve simultaneously buying and selling options with the same expiration date on the same asset, but at different strike prices. 4. Bull spreads achieve maximum profit if the underlying asset closes at or above the higher strike price. Hope this would help. Thanks for watching.